This is a presentation for Chapter 14, the Statement of Cash Flows. This presentation will be Part 1 of Learning Objective 14.2 on preparing the Statement of Cash Flows using the indirect method, and in this portion we will cover the operating and investing activities sections. So first we're going to talk about how we prepare the statement of cash flows using the indirect method. Before you begin to prepare the statement of cash flows, you need to get some items. First, the income statement for the current year. Next, the balance sheets for the current and the prior year, and you will also need some additional information based on a review of transactions. So for this portion of the presentation, we're going to use a fictitious company, a retail store called ShopMart Inc. that sells electronics, home furnishings, home supplies, and more. So how do we prepare the statement of cash flows? It is prepared in 5 steps. First, you complete the cash flows from operating activities, then investing activities, and financing activities. After you determine those, you add the net cash provided or used for each one of those to net income, and you will compute the change in cash. You will add that change in cash to the beginning cash balance, and then the ending cash balance should equal the cash in the balance sheet. Next, you will prepare a schedule for any non-cash investing and financing activities. On this slide, we see a comparative balance sheet for ShopMart Inc. for the years ending December 31st, 2024 and 2023. So you have to determine whether there has been an increase or a decrease in each one of the balance sheet accounts from 2023 to 2024. And we will use that information to prepare the statement of cash flows. Next, you will need information from the income statement. The indirect method of the operating activities section begins with net income, but there is also other information from the income statement that you need to prepare the operating activities section, such as the depreciation expense on plant assets of $20,000 and the gain on the disposal of plant assets of $10,000. This slide shows a completed statement of cash flows for ShopMart Inc. using the indirect method. So let's look at this statement. The indirect method for operating activities begins with net income. And then we show adjustments to reconcile net income to net cash provided by operating activities. We begin with adding back any non-cash expenses that were subtracted to get to net income. We would add back any gains on the sale of long-term assets. Then we would either add or subtract increases and decreases in the current assets and current liabilities. We get a subtotal of all of the adjustments, and we add those to net income to determine net cash provided by operating activities. Then we will analyze the long-term assets to determine the net cash provided or used for investing activities. We will analyze our long-term liabilities and equity accounts to determine the net cash provided or used by financing activities. And then we will add together the net cash provided by operating, investing, and financing activities to determine the net increase or decrease in cash. That amount will be added to the beginning cash balance, and then we will determine the cash balance at the end of the year. That cash balance should equal the cash that is shown on the balance sheet. Now we are going to talk about how to determine the cash flows from operating activities using the indirect method. The operating activities section will always begin with accrual basis net income or net loss, but then it will need to be adjusted. Revenues bring in cash receipts, and expenses must be paid. But remember that net income that's shown on the income statement is accrual based, and the cash flows, cash basis net income, doesn't always equal the accrual basis revenues and expenses. For example, sales on account will generate revenues and that will increase net income. But that doesn't mean the company has collected all the cash from those sales. If there is a balance in accounts receivable or accounts receivable has increased, then we know that we did not collect all of the money from the sales. Accrued expenses also decrease net income, but the company hasn't always paid for all of those expenses. Some may be only accrued. So to go from net income to cash flow from operating activities, we must make some adjustments to net income on the statement of cash flows. These additions and subtractions will follow net income, and they're labeled adjustments to reconcile net income to net cash provided by operating activities. The first adjustment that we make in the operating activities section is for any depreciation, depletion, and amortization expenses that have been subtracted from net income, because these expenses do not involve cash. As we see on the slide, when we record depreciation expense, we debit depreciation expense plan assets and we credit accumulated depreciation plan asset. There is no cash involved in that transaction, but it decreases net income. So depreciation needs to be added back to net income to get to cash provided by operating activities. Also, any gains and losses on the disposal of long-term assets are going to either have been added in the case of a gain or subtracted in the case of a loss to determine net income. However, these gains and losses are not part of the operating activities section of the statement of cash flows. The gain or loss must be removed from net income on the statement of cash flows so that the total actual cash receipts from the sale of the assets can be shown in the investing activities section. And that is, in this case, if it's a gain, then we would need to subtract the gain in order to determine cash flows from operating activities. On the other hand, if it's a loss on the disposal of plant assets, that would have decreased net income on the income statement, so we would need to add back any losses on the sale of plant assets to determine net cash provided by operating activities. The next thing is we need to include the changes in our current assets and current liabilities. So the rules are that an increase in a current asset other than cash causes a decrease in cash. So in this case, the increase in accounts receivable would need to be subtracted. A decrease in current assets other than cash causes an increase in cash. So in that case, the decrease in merchandise inventory of $2,000 would need to be added back. An increase in a current liability causes an increase in cash. So the increase in accounts payable of $40,000 would need to be added back. A decrease in a current liability causes a decrease in cash. So a decrease in accrued liabilities of $5,000 would need to be subtracted. After we have made all of our adjustments, we need to get a subtotal of all of the items in the adjustments to reconcile net income to net cash provided by operating activities. In this case, that total is $30,000. We add that to our net income and we get net cash provided by operating activities of $70,000. Now let's review quickly what we just went over about evaluating cash flows from operating activities. We always start out with accrual basis net income, and then we make adjustments to determine cash basis net income. The first adjustment would be to add back all non-cash expenses to net income. Expenses such as depreciation expense, amortization expense, or depletion expense represent expenses that are not related to current cash flows. Next, we need to subtract any accounting gains from net income. These gains, such as the gain on the sale of the land, are not cash flows that are related to operating activities, so they need to be eliminated from net income or they'll be counted twice. Add accounting losses back to net income. These losses, such as a loss on the sale of equipment, are not cash flows that are related to operating activities, so we have to eliminate their effects from net income. Losses are added back. When current assets increase, we treat that as a use of cash and we subtract it from net income. When current assets decrease, we treat that as a source of cash and we add it to net income. When current liabilities increase, we treat that as a source of cash and we add the increase to net income. When current liabilities decrease, we treat it as a use of cash and we subtract the decrease from net income. Next, we're going to talk about how to determine the cash flows from investing activities. If you remember from the first presentation, investing activities affect long-term assets such as property, plant, and equipment, investments, and long-term notes receivable. It's helpful sometimes to use a T account to analyze the transactions that have affected these long-term assets so that we can determine if there were any acquisitions or disposals. Let's look at the plant assets and accumulated depreciation accounts for ShopMart Inc. We see that at the beginning of the year, ShopMart Inc. had $252,000 in plant assets. During the year, they acquired or purchased $310,000 of plant assets, and they disposed of or sold $55,000 of plant assets. At the end of the year, the balance in plant assets was $507,000, or a change in that account of $255,000. When we look at the accumulated depreciation for plant assets, we see that at the beginning of the year, it had a balance of $42,000. It was increased by the entry to record the depreciation expense of $20,000, and it was decreased when we sold or disposed of the plant assets, and that amount was debited at $15,000. So the change in accumulated depreciation for this year was $5,000. Now, the information that we can derive from these T accounts will help us to complete the statement of cash flows. For one thing, we can see that we acquired $310,000 in plant assets. That is a use of cash. We also see that we probably received cash when we disposed of the $55,000 of plant assets, but we need to look at that transaction carefully to determine what was the actual cash that we received when we disposed of those assets. Sometimes it helps to reconstruct the journal entry that would have been recorded when the plant assets were disposed of. We saw from the T account that we had a credit to plant assets of $55,000. We also saw from the accumulated depreciation account that we had a debit for the accumulated depreciation on those assets of $15,000. So from that we can see that the book value of the assets that were disposed of was $40,000. $55,000 minus $15,000. But if you remember, we saw on the income statement that there was actually a gain on the disposal of plant assets of $10,000. So when we add the $10,000 to the book value, $40,000, we can determine what the actual cash was that we received on the disposal of the plant assets, $50,000. Now we have the information that we need in order to be able to complete the investing activities section of the statement of cash flows. As you can see from this slide, we always report our cash receipts and our cash purchases or cash payments separately in the investing activities section. So first we show the cash payment for the acquisition of plant assets. If you remember, that amount was $310,000 that we saw in the T account. Then we show the cash receipts from the disposal of the plant assets that we determined by analyzing the transaction. That is $50,000, and that was a receipt of cash. When we add those two together, we get an overall net cash used for investing activities of $260,000. When the amount is a negative, it should say net cash used for investing activities. If that had been a positive, we would use the words net cash provided for investing activities. And that is the conclusion of part 1 of the second learning objective for chapter 14.